Let them eat treasuries. Fed hikes rates again as banks fail and default looms. Hello, this is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button. Today, we're going to be talking about the Federal Reserve. They have once again hiked the federal funds rate. That's the rate that the central bank lends to other banks. And it had been at 4.75 to 5%. Now it's up to 5% to 5.25%, but the Fed is indicating that it might be about ready to start freezing that rate. That is until such time as the inflation comes down. It had peaked at 9.1% in June of 2022. It is now down to about 5%, according to the Bureau of Labor Statistics. And we're just going to jump straight into the Fed's statement today. Federal Reserve issues FOMC statement. This is May 3rd. This is today. And if you scroll down a little bit, it says the committee seeks to achieve maximum employment and inflation at the rate of 2% over the longer run. That's the inflation rate they want to see at 2%. In support of these goals, the committee decided to raise the target range for the federal funds rate to 5 to 5.25%. The committee will closely monitor incoming information and assess the implications for monetary policy. In determining the extent to which additional policy firming may be appropriate to return to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. In addition, the committee will continue to reduce its holdings of Treasury securities and agency debt and agency mortgage-backed securities as described in its previously announced plans. The committee is strongly committed to returning to 2% inflation objective. Now, what's different about this statement compared to the one that they issued in late March is this statement around the appropriate additional policy firming may be appropriate to return inflation. Back in March, what they said about the additional policy firming was that the committee anticipates that some additional policy firming may be appropriate. So in March, they were saying we're still going to probably have to keep on tightening. Now they're saying we're going to take a wait and see approach where in determining the extent to which additional policy firming may be appropriate. And so this is what investors are keying in on right now. This is Jeff Cox over at CNBC. Fed increases rates a quarter point and signals a potential end to rate hikes. The Federal Reserve on Wednesday approved its 10th interest rate increase in just a little over a year and dropped the tentative hint that the current tightening cycle is at an end. In a unanimous decision widely expected by the markets, the central bank's Federal Open Market Committee raised its benchmark borrowing rate by 0.25 percentage point. The rate sets what banks charge each other for overnight lending, but feeds through to many consumer debt products such as mortgages, auto loans, and credit cards. The increase takes the Fed funds rate to a target range of 5% to 5.25%, the highest since August of 2007. Markets, though, are more focused on where the Fed will be going from here, particularly amid concerns over economic growth and a lingering bank crisis that has rattled the nerves on Wall Street. The post-meeting statement offered only some clarity, but not by what it said, but what it didn't say. The document omitted a sentence present in the previous statement that was saying the committee anticipates some additional policy firming may be appropriate for the Fed to achieve its 2% inflation goal. Also, the statement tweaked the language to outline the conditions under which, quote, additional policy firming may be appropriate. Previously, the FOMC had framed the forward guidance around how it would determine the extent of future increases in the target range. So the Federal Reserve is hiking interest rates, but it may be about to pause. And I think one of the things that they're looking at is the comparison between the federal funds effective rate and consumer price index, as reported by the Bureau of Labor Statistics. What you see on the screen there is a chart. The red line is inflation. The blue line is the federal funds rate. And when you see spikes in inflation in the 1970s and the early 1980s, the Federal Reserve is going to hike interest rates. And what that does is it increases the rate that banks are borrowing. Therefore, it's going to increase the rate that everyone else is borrowing as well, down to the consumer level. But when you increase the rate at which banks are borrowing from the Federal Reserve, that's going to soak up some of the excess money supply that's created during the business cycle, and particularly after COVID. We printed $6 trillion. We added to the M2 money supply. It went up by like 39%. At the same time, we were doing economic lockdowns and production halts. And as a result, inflation went to the moon. It peaked at about 9.1%. This is June of 2022 Consumer Price Index news release from the Bureau of Labor Statistics. Over the last 12 months, the all items index increased 9.1% before seasonal adjustment. But in the BLS's most recent release, that was down to 5%. And so I think that we're seeing a situation where the inflation rate is coming down, and it's going to cross paths with the federal funds rate. And it's nearly to the same point, but it hadn't quite crossed the threshold yet. In all of the previous, recessions and business cycles that we've been through, the Federal Reserve almost always will take the federal funds rate above that of the consumer inflation rate. And it hadn't done so yet. It could have done so already if it had just begun hiking rates back in 2021, but it waited all the way until February and March and April of 2022 after Russia had invaded Ukraine, further exacerbating the supply chain crisis that was started. It started before COVID, but it got even worse during COVID. And then as Russian oil was coming off of global markets, there was an even further supply squeeze. And so then the Fed says, hey, maybe we should start hiking interest rates. But by then, inflation was already 7.5%. And again, it would peak at about 9.1% in June of 2022. And now, by the looks of it, with the Fed taking right now, the effective funds rate is at about 4.8%. Once it goes up above 5%, to 5.25%, you're probably see inflation continue to cool off, even if just a little bit, when the next report comes out from the Bureau of Labor Statistics. And so the federal funds rate will then be safely above that of the consumer inflation rate. And what investors are anticipating from here on out is that it's going to kind of keep it there. Now, prior to this meeting, you can tell Democrats are really worried about the economy. Lawmakers led by Democrats urged the Fed to halt rate hikes ahead of Wednesday's announcement. This is Chelsea Cox from CNBC. A group of lawmakers, including Senator Elizabeth Warren and Representative Pramila Jayapal, urged the Fed to halt its rate hikes. The request came the day before the Fed is expected to raise its benchmark rate by a quarter of a point. A group of several prominent Democratic lawmakers are calling on the Federal Reserve to halt rate hikes to avoid risking too much damage to the economy. The 10 senators and representatives, led by Elizabeth Warren, raised their concerns about the Fed's monetary policy strategy and its, quote, potential to throw millions of Americans out of work. In a letter Monday to Fed Chair Jerome Powell, the letter was sent ahead of the Fed's anticipated rate hike announcement Wednesday. It would be the 10th increase in the past year as the central bank has tried to tame inflation. Some expect the Fed to pause hikes after Wednesday. The lawmakers called on the Fed to suspend rate hikes to, quote, respect its dual mandate and to, quote, avoid engineering a recession that destroys jobs and crushes small businesses. Now, during a February 1 press conference, Jerome Powell, he's the Federal Reserve chairman, said he continues to think that, quote, there's a path to getting inflation back down to 2% without a really significant economic decline or significant increase in unemployment, though he also noted that most economic forecasters would predict an uptick. While we do not question, quote, the Fed's policy independence, we believe that continuing to raise interest rates would be an abandonment of the Fed's dual mandate to achieve both maximum employment and price stability, and show little regard for the small businesses and working families that will get caught in the wreckage, the lawmakers wrote. This is Elizabeth Warren's letter again. She's saying, oh, we're not questioning your independence, but we believe that this is going to harm the economy if you keep on raising interest rates. I think what they're really scared of is that typically when inflation is coming down, that's a signal that demand is weakening. We saw last month that OPEC, kind of lowered their production level, and oil prices jumped up to over $80 a barrel, but now it's down below $70 a barrel again as demand is weakening. So when you see inflation calming down, after you get to peak inflation, you're expecting a recession to come sometime thereafter because the economy's overheating. And so people are going to start to lose their jobs, basically. And there's usually an inverse relationship between inflation and unemployment, such that when inflation is falling, you could see unemployment rising. That's what usually happens in a normal business cycle, and just historically, that's how it kind of works. Demand is weakening, so you have fewer products going out the door. Businesses that were trying to expand, they're going to slow down job hirings. We've seen job openings actually starting to drop significantly from more than 12 million almost a year ago down to about 9.9 million right now. And if that continues to go down, then you're expecting to see some layoffs come into the mist. The Federal Reserve and also the White House Office of Management and Budget are actually projecting that the 3.5% unemployment rate that we see today could rise to, say, 4.3% this year, and then up to 4.6% in 2024. When President Joe Biden's going to be standing for re-election. And I think that's what Democrats are really worried about, is that there's a recession on the horizon and they're looking for somebody to blame. And so Jerome Powell and the Federal Reserve are going to be a convenient punching bag for a political administration and partisans who are going to want to say that, oh, the Fed caused the recession somehow. No, it was printing $6 trillion for COVID, doing economic lockdowns and production halts, where you have too much money chasing too few goods, and then prices naturally were going to rise. They reached 9.1% in June of 2022. And it wasn't until by then the Fed's finally hiking interest rates. But if the Fed had just gotten started with hiking interest rates, maybe we would have already seen the interest rates rise much faster. The business cycle could have ended sooner. It just so happens that they paused their, tightening cycle, and they postponed it, maybe for political reasons. They didn't want to get a recession before, the Democrats and Biden are going to run for re-election or something like that. But once inflation was really rocketing upwards, they were left with no choice. And that might actually, because they kind of stalled in raising the rates, they might have put the recession that could already almost be over maybe into 2024, when Biden's going to be standing for re-election. If the unemployment rate goes from 3.5% to 4.6% next year, well, that's an implied 2 million jobs lost. So that's not going to be a very strong record for Joe Biden to run on. And then when you couple it with what's going on with the banking crisis right now, 3 major regional banks have failed now. First Republic Bank was just taken over by the FDIC and then spun into JP Morgan. This is a really serious situation where we're seeing, because banks tend to purchase treasuries, and they were buying them when rates were at really, really, interest rates were really, really low. There's an inverse relationship between interest rates and the value of bonds. So as interest rates have been rising, the value of the bonds that they purchased yesterday have been falling. And as a result, banks are sitting on something like $600 billion of unrealized losses. Here it is. Bank losses are hiding $600 billion in unrealized losses to keep their mega bonuses. Well, let's not talk about the bonuses. So here's $100 billion run on deposits, rising interest rates, put First Republic Bank into FDIC receivership. JP Morgan takes over as another one bites the dust. The Federal Deposit Insurance Corporation and the California Department of Financial Protection and Innovation put the $229.1 billion California-based First Republic Bank into receivership today on May 1. This was a couple days ago, while the FDIC also entered into a, quote, purchase and assumption agreement with JP Morgan Chase Bank for the nation's largest bank, that's JP Morgan, to assume First Republic's assets, as well as its $103.9 billion of deposits. Another one bites the dust. Under the agreement, quote, all depositors of First Republic will become depositors of JP Morgan Chase Bank National Association and will have full access to all of their deposits, according to the FDIC. Here's the statement that came out on May 1. JP Morgan Chase Bank, Columbus, Ohio, assumes all the deposits of First Republic Bank, San Francisco, California. And this is, again, a major situation. We've seen Silicon Valley Bank and Signature Bank. They failed just a couple of months ago. And the FDIC, yes, they put them into receivership. But this Financial Oversight Stability Council, created under Dodd-Frank, also declared that those banks were systemically risky. The difference between Silicon Valley and Signature Bank is that they were declared systemically risky, but First Republic Bank was not. They went through the traditional FDIC receivership route, and they actually negotiated a sale of this bank to JP Morgan, which is now taking all of the assets and all of the liabilities of the bank. Obviously, either way, shareholders were going to be wiped out. First Republic Bank had the 96% drop to $3.05. It had been at $147 per share, and then just fell off a cliff as the banking crisis was unfolding because they had so many uninsured deposits. And what does that mean? That means that the FDIC guarantees up to $250,000 of deposits. Well, these were, major businesses and investors and other entities, financial institutions, or whoever who have deposits at these kind of left coast or west coast banks that are, into Silicon Valley, they're into big tech. And as you have this consolidation of massive wealth into these banks, into just a few of these regional banks, and then treasuries the interest rates are rising, the bond values are falling, and then banks are seeing unrealized losses. And that's what happened to Signature. That's what happened to First Republic. That's what happened to Silicon Valley Bank. Once again, like Silicon Valley and Signature, the bank was caught upside down on interest rates. It bought treasuries and mortgages when interest rates were much lower, which when rates rose, drove down the value of the paper they were printed on due to the inverse relationship between interest rates and bond values, causing a run on uninsured bank deposits of more than $100 billion in March. We have a statement here from First Republic Bank that shows kind of its quarterly earnings or lack thereof in this case. And it shows that deposits were down $104.5 billion, down 35%. So that's a massive bank run. We're losing $100 billion of deposits. And so by now it's almost half of what they have left right now. There's $103 billion worth of deposits that are left that are now going over to JP Morgan Chase. As a result of the run on regional banks, the second, third, and fourth largest bank failures in American history have taken place in just the past month or so. The SPDR S&P Regional Banking ETF has dropped a whopping 34% since the beginning of February, from $64.72 per share down to $42.66. That was a couple of days ago. Let's see where it is now. The regional banking index is now down to $39.56. So it had been at a recent high of $64.79. Now it's down to $39.56. When I wrote the piece, it was at $42.66. So I'd say that the pressure is still on these regional banks throughout the nation, and something to be watchful for. It's causing a massive shift to larger banks. We're going to see much more consolidation in the financial industry right now as these smaller regional banks and community banks, they're going to have more pressure on them as people say, hey, are they holding treasuries too? Maybe they're upside down. Maybe they're a part of the $600 billion of losses. Maybe I should put my money in JP Morgan Chase. Maybe I should put my money in Bank of America rather than risking keeping it in one of these smaller banks. And so you're seeing big bank runs occur right now as a result of this. This followed Wall Street's panic rush in March to recapitalize First Republic with a reported $30 billion infusion by putting deposits into the bank, but notably not purchasing shares in the bank, which failed to save the bank as regulators finally stepped in. So there was a push on Wall Street to attempt to save First Republic Bank. But Dow jumps. This was on March 16th. Dow jumps 300 points as banks step in to aid First Republic. And all three index were traded down. The SPDR, we talked about that. Also boosting, let's see, investors have been watching closely after the closures of Silicon Valley Bank and Signature Bank prompted concerns of contagion and in the sector in recent days. Despite concerns in the sector weighing on the minds of investors, all three indexes are on pace to go higher. And so there's this push to save First Republic Bank, and then it fails. And then the FDIC is putting it into receivership. And that's just another one biting the dust. Again, the unusual move in March for the failed deposit infusion was due to the conditions of putting both Silicon Valley Bank and Signature Bank into receivership, and it being deemed too big to fail by the Treasury, Federal Reserve, and the FDIC, per the department and agency's joint statement. Quote, shareholders and certain unsecured debt holders will not be protected. And this was a provision of Dodd-Frank, 12 USC 5390A1M. So this is one of the laws that was passed back in 2010, Dodd-Frank, after the financial crisis and the Great Recession. And there was this orderly liquidation fund that was created under this law. And under the law, it states, quote, the corporation shall ensure that shareholders and unsecured creditors bear losses consistent with the priority of claims provisions under this section. And as a result, there was a zero incentive for larger financial institutions to really step in and purchase First Republic outright, even for pennies on the dollar, until after the bank had been seized by regulators. No one wanted to be left holding the bag on all of these losses if the bank was just going to be put into receivership and shareholders weren't going to be compensated. So what's the incentive to hold on to First Republic Bank once you know it's going to fail? Its stock plummeted, and it basically guaranteed its failure. And then you have a run on bank deposits. And that was going to kind of, the fact that the stock was plummeting was going to ruin its capital ratio, the amount of capital it holds versus its liabilities, which include deposits. Ironically, by doing the bank run, it probably improved their capital ratio in time for the FDIC to step in. And then JP Morgan Chase Bank is assuming all of those assets and all of those liabilities. Let's see here. And with large deposits at the bank being well in excess of the $250,000 statutory FDIC limit for insurance, as First Republic became undercapitalized, it could not possibly withstand the bank run, leading to the $100 billion withdrawal of deposits. Now, with the assets and liabilities of these smaller regional banks being transferred to Wall Street superbanks, the further consolidation of the nation's financial system continues. Although, to be fair, no private bank, no matter how well capitalized, can possibly withstand bank runs of these magnitudes. A quick look at the capital ratios of major financial institutions shows. So if you look at let's see here, where's Statista? It could show us the bank rate, the common equity tier 1 capital ratio of largest banks in U.S. So you see JP Morgan Chase Bank, they're at 12.1%. Bank of America's at 10.5%. Wells Fargo's at 10.4%. Citigroup at 11.9%. PNC, 9.6%. US Bancorp, 9.7%. and so forth. Truist 9.2%, Goldman Sachs 14.2%, TD Bank 16.6%. So with that, the implication is that if more than, say, 13% of bank customers at any of these larger banks were to suddenly go and withdraw their funds, they would all fail. In the case of First Republic's, deposits fell almost by half. So when you see a bank stock plummeting, it's going to incentivize people to pull out their assets if it's over the $250,000 FDIC insurance limit. For now, the implicit backing of the federal government and the perception of too big to fail, plus perhaps the sneaking suspicion that there's nowhere better to put one's money, seem to be generally what is keeping the system together. So if you're thinking about like stuffing money in your mattress, you might think, well, I've got my money at Bank of America, or I'm at Chase. They're too big to fail. That bank's probably safe. If anything happens, the government will bail them out or something like that. But long term, the incentive is for even more consolidation. This is what I'm worried about going forward, especially when one considers the nation's fiscal and debt outlook over the next decade, with $31 trillion debt right now set to rise to $50.7 trillion, according to the White House Office of Management and Budget. This is a pretty dire situation, I think, that we find ourselves in here. If you look at the White House budget, this is from, this is Joe Biden's economic team that are putting this together. Gross total debt subject to the statutory limit is going to rise to 32.7 trillion this year in 2023. Right now, we're at 31.4 trillion. Congress is still negotiating a debt ceiling increase with the White House. We'll see if we get some spending cuts out of that. More on that in a minute. But the debt's going to rise to 50.7 trillion by 2033, according to the White House. That's gargantuan. But it's kind of predictable. And I ask the question, who's going to buy all of these treasuries? Foreign central banks have been reducing their overall share of the national debt. In December of 2008, foreign central banks and financial institutions owned 3 trillion out of 9.9 trillion, or 31% of the debt. But in January of 2023, they owned 7.4 trillion out of 31 trillion, or 23.5%. So they went from 31% to about 24%. And we can actually pull that up over here. And you can see these are the major holders of foreign holders of treasuries. And that number is sitting at 7.4 trillion, but it was at 7.655 trillion in January of 2022. And the result, it's decreasing actually. So the reason for that is because China went from $1 trillion to $860 billion of treasury holdings. China is dumping its treasuries right now. And that's going to be a major kind of sticking point going forward. Are they going to keep dumping their treasuries? What's going on with that? Is that a prelude to war? We've spoken about this previously. In response, the Federal Reserve, on the other hand, has increased its share of the debt from $790 billion in August of 2007, when the global financial crisis began, or 8.8% of the $9 trillion debt, to 5.3 trillion out of 31 trillion, or almost 17% as of April 2023. So here's the Fed's balance sheet, factors affecting reserve balances of depository institutions. You can see here in 2007, they held 790 billion.8. And then by today, they have $5.286 trillion of U.S. treasuries, a whopping increase. They also hold about $2.6 trillion of mortgage-backed securities, and their balance sheet has just ballooned. Reserve bank credit is at the 8.6 trillion today. Back then, it was at 850 billion. It went up tenfold. So the amount of money that we're printing, I think, to shore up the U.S. Treasury market, but also the U.S. mortgage market, has increased dramatically. And this is going to really weigh on things. So where else might we get the money to borrow this $31 to $50 trillion? Although if you look at the national debt, it's actually been growing at about more than 8% a year. Every single year since 1980. It's about 8.8% on average, actually. But if it keeps growing at that rate, even if it's just 8%, it might be $69 trillion by 2033. Get a couple wars or maybe a recession or two, And yeah, you'll see $69 trillion by 2033. But if it goes at 8.8%, wow, you could get to $100 trillion of national debt as soon as 2037. And again, who's going to buy all these treasuries? If it's 50 trillion or 100 trillion, it's a real question. We're not going to borrow it from grandma and grandpa, I'll tell you that much. $6.7 trillion of debt that is held by the Social Security Medicare trust funds is also a dwindling share of the debt from 4.3 trillion out of 9.9 trillion in 2008, or 43% of the debt. Now it's risen some to 6.8 trillion, but that's out of $31 trillion of debt. So they've gone from 43% the trust funds down to 21% of the trust funds, which are set to be exhausted over the next decade or so. That leaves U.S. financial institutions, that is banks, but also retirement funds, hedge funds, and mutual funds and the like, to buy the rest of the treasuries, rising from about 17% in 2008 or 1.7 trillion to a massive 11.9 trillion or 38% today, the largest single debt holder. So banks and retirement funds, investors, hedge funds, mutual funds, they are now the largest holder of the debt. And I don't think foreign banks are going to keep on lending us all of this money. I don't think they can afford to. That's why they're reducing their treasury holdings right now. So if we're going to go from 31 trillion to 50 trillion or 69 trillion or 100 trillion, we're going to need to borrow that money from somewhere. We're not going to get it from the grandma and grandpa. We're not going to get it from these intergovernmental holdings. Those are going to be drawn down. $24.6 trillion of the $31.4 trillion is publicly traded. The Fed buys treasury debt on the open market. They do debt held by the public. And so the Fed's share of the debt actually comes out of the 24.6 trillion. The 6.8 trillion are non-marketable securities, these intergovernmental holdings in the Social Security and Medicare trust funds. What the Social Security and Medicare were doing all these years was they would get a bunch of cash, they get a bunch of surpluses, they were taking in more revenue than they were doing expenditures every single year. So they said, let's earn some interest on that. We'll buy treasury bonds. And that's what the trust funds have always been. And there it adds up to $31.4 trillion. But depending on how bad inflation is, will determine how bad interest rates are and potentially how upside down the financial system is on interest rates next time. Then yet the financing we obviously need will have to come from larger banks in the US, meaning probably more regulation, more capital controls. Can you say digital currency? My goodness, oh God. Higher insurance premiums and fees, and much larger asset prices, all to keep the financial system solvent. And the price is going to be less liberty. I'm really concerned about this digital currency, that we're having these regional and smaller banks failing, and then everyone's moving into the larger banks, which are going to demand some sort of protection against bank runs. And that's why I think a digital currency is really being pushed right now. Is they don't want you to have cash. They don't want you to have the ability to take your money out of a bank account because they're afraid that the financial system's going to crash, and then that we're not going to be able to meet our treasury obligations. And that, that's going to be a sad day. Could we see a national default coming on the horizon? My goodness. Already the Federal Reserve's new bank term funding program, which I say is renting treasuries from banks at 100 pennies on the dollar, has risen from 11 billion in March to more than $81 billion today. This is a pretty dire situation. You can see here, this was in March, the bank term funding program. We have to scroll over now to show that it's at $11.9 billion in March. Again, this is the bank term funding program. And when you go to today's release, you can find the bank term funding program is at 68 billion, but here it is at $79 billion. It's dramatically increasing right now. And I think we could see even that getting even larger. When you look at the balance sheet of First Republic Bank, they only had borrowed about $2 or $3 billion under the bank term funding program. So you get the feeling that there's a lot more banks that are in trouble right now if that thing's getting up to $79 billion in this bank term funding program, and you should be concerned about that. The further that goes up, that indicates even more losses. And they're already, if these are the unrealized losses that they're now saying, hey, Fed, would you mind, can you want to rent these treasuries for 100 pennies on the dollar until interest rates come back down? Would you mind doing that pretty please? And the Fed's like, you gotcha, no problem. We'll take those treasuries off your hands. And that's what they're going to do when the Fed's done hiking rates. Inflation's coming down, and then they're going to pause for a while. Then once the economy goes into recession, unemployment starts rising. The Fed says 4.6% unemployment by 2024. 2 million jobs could be lost. Then the Fed will say, all right, we've got wiggle room here. We're going to start to ease interest rates now. And by that time, hopefully the banks are thinking we won't have to roll over this bank term funding program. But my guess is that the Fed will hold on to these treasuries for as long as it takes to absorb it's not actually a loss that the banks are taking. These are unrealized losses, and they only come if the banks sell the bonds at a lower price. So they're saying, we don't want to sell these bonds. We want to let the Fed hold on to them for us and give us 100 pennies on the dollar so we can recapitalize and get to a point where, we can meet our capital common equity tier 1 capital ratio requirements under federal law and under Dodd-Frank. In addition, FDIC reported about a $13 billion loss will be assessed to the Federal Deposit Insurance Fund as a result of the receivership of First Republic Bank. You have to scroll all the way to the bottom of the release to see that. The FDIC estimates that the cost of the Deposit Insurance Fund will be about $13 billion. This is an estimate, and the final cost will be determined when the FDIC terminates the receivership. So you got $13 billion here. $79 billion there. We're already up to almost $100 billion of what's going to be a bank bailout, basically. And when the Fed goes back and they start increasing treasury holdings again, they're still in a decreasing, tightening mode right now. They're getting rid of their treasuries and they're hiking interest rates at the same exact time. Eventually, they're going to start purchasing treasuries again as banks are going to, and interest rates are dropping, and banks are going to say, we need more cash. And the Fed will say, hey, we'll buy those treasuries, and they'll start increasing again. So they're at 5.3 trillion right now. They're at almost 17% of the national debt. How big will the Fed's share of the national debt be after this imminent recession that a lot of people are anticipating right now? It's a really good question. So far, 3 major bank runs have occurred in the span of a little more than a month. This thing could just be clearing its throat, even as worried investors hope the worst is past us. I guess we'll see. These are uncharted waters. Hang tight. And hang tight, because we're going to jump over here. Joe Biden is playing a game of chicken. While all this is going on, we have the debt ceiling that is looming right now. And Joe Biden, he wants to just have Congress increase it. He's saying we have to have a no strings attached increase of the $31 trillion debt ceiling. We're not going to cut any spending. Even if I say the debt is going to $51 trillion, that's Biden's budget projection, we don't want to cut a single iota of spending. I mean, look at this guy. He doesn't want to cut any spending. He's saying we're going to default I threaten default if Republicans try to cut spending and get our fiscal house in order. But, there could be a ray of sunshine here. President Joe Biden is set to meet with House Speaker Kevin McCarthy and other congressional leaders on May 9th to discuss the looming $31.4 trillion debt ceiling. It's about time, I say. Here it is. McCarthy and McConnell accept Biden's invitation to debt ceiling meeting. The president invited congressional leaders to meet May 9th, hours after the Treasury Department warned that the U.S. needs to raise the debt ceiling as early as June 1. That's a quote. So it's May 3rd right now. By June 1, if they don't increase the debt ceiling, well, I got news for the White House. The House Republicans, House of Representatives, has already increased the debt ceiling, and they've done it via the Limit, Save, Grow Act that's going to reduce deficits by almost $5 trillion, according to the Congressional Budget Office. This is actually really good news in terms of getting our fiscal house in order. We're having these regional bank failures right now. We've gone through the size of the debt. We've gone through treasury holdings. We've gone through central bank purchases. We had the spending splurge from COVID, 9.1% inflation by June 2022. And so, what does everyone think's going to happen when we follow the baseline spending plan under current law that takes annual outlays from 6.3 trillion in 2023? That's the budget this year. $6.3 trillion to $9.9 trillion by 2033. This is absolutely outrageous. But this is current law baseline. Baseline by category. This is the White House Office of Management and Budget. And again, you see 2023 here, total outlays, $6.376 trillion. It'll rise to $9.954 trillion by 2033. Again, we noted that the national debt will be $50.7 trillion by then, according to the White House Office of Management and Budget. I mean, just from 2024 to 2033, consider this, we're going to spend $80.4 trillion. And the reason for that is baby boomers are retiring, and you're having a massive retirement wave right now. And so Social Security and Medicare spending is going to be growing by leaps and bounds. It's going to rise from $1.3 trillion in 2023 to 1.3 trillion to 2.4 trillion by 2033. And Medicare spending is going to go from 820 billion all the way up to 1.8 trillion by 2033. Net interest owed on the debt, that's going to go from $665 billion to $1.4 trillion by 2033. So you're going to have an increasing interest, debt burden. You're going to have an increasing, size of Social Security and Medicare as the federal government keeps its, promises to seniors. And so because of that, the intergovernmental holdings, there's fewer taxpayers relative to the amount of retirees. And so this is going to be running at a deficit now, Social Security and Medicare, unless there were more taxpayers. But baby boomers didn't have enough children, truth be told. Neither did Gen X, and neither are millennials, and certainly not Gen Z. And so fertility's been plummeting, and as a result, there's a shrinking ratio of retirees to workers. And the program actuarially was founded at a time when you had really high fertility. And so when they, baked in all of these defined benefit kind of, defined benefits into the program, it was at a time when fertility was much higher. Now fertility is much lower. And as a result, fewer workers means fewer taxpayers. And so the trust funds are going to be insolvent within a decade or so. And then Congress will have to make up its mind. Are they going to cut spending for Social Security and Medicare? I think they'll probably just, take it out of the general fund. And then all of this 6.8 trillion is just going to jump over here to debt held by the public. And then whatever the, U.S. banks and foreign investors, whatever they can't handle, the Federal Reserve's going to intervene. But again, U.S. banks in general are going to get much, much larger. So what do we think is going to happen when we go from 6.3 to almost 10 trillion by 2033? Any wars or recessions between now and then, the national debt at 51 trillion could be a lot more than that. I think it's going to be more like 69 or 70 trillion, or maybe even 100 trillion by 2037 if it gets really bad with the recessions, or if there's another war or two. And whatever shortfall there is in financing from foreign and U.S. banks, the Fed has already demonstrated that they will intervene. But they can't do it all. And so U.S. financial institutions will continue to bear an increasing debt burden. If inflation jumps again, so will interest rates. And U.S. banks that we all depend on will feel the pain, having already claimed First Republic Bank, Silicon Valley Bank, and Signature Bank. All told, banks are said to be sitting on 600 billion of potential losses, simply because as interest rates rose again, they must to combat inflation, the value of the government bonds decrease. And so I say this is an unsustainable system. We're going to be mounting all of this treasury debt, and we can't possibly, the banks can't hold it all. The Fed can't hold it all. Foreign central banks and foreign financial institutions, they can't hold it all. And ultimately, I fear it's going to lead to a digital currency as banks demand protection from bank runs when they come under stress, which is going to lead to more bank failures and further consolidation into fewer, larger institutions, and take ever more liberty from the American people who are hostages in this game of chicken that we are playing with the debt. Now, in contrast, House Speaker Kevin McCarthy and House Republicans have passed a plan, the Limit, Save, and Grow Act, that increases the debt ceiling, yes, but in exchange for real spending cuts from the currently spiraling baseline spending. The Congressional Budget Office has released its estimate of the plan, HR 2811. You should urge your members of Congress to support this legislation. If you got the newsletter today, there's a link in the newsletter to urge Congress. The House has already passed it, but the Senate's on that action alert as well to cut spending right now. And this bill will actually reduce budget deficits by a whopping $4.8 trillion through 2033. This is a really good news for the American people. This is the CBO estimate of the Limit, Save, Grow Act of 2023. And the savings are going to mount over the years. And you see that in 2023, the projected changes, they're going to end the student loan forgiveness program that Biden put forward, energy tax provisions. Those are going to go down across, all these subsidies for green companies, windmills and solar panels and electric vehicles and the like. They're getting rid of all of that. And so the student loan forgiveness reduction, that will save $460 billion. Caps in discretionary spending. This is where the real money is. It's going to be $3.2 trillion discretionary spending caps that start at $129 billion cut in 2024 off of the baseline, $202 billion in 2025, up to 243, 279, 314 billion, 342 billion, 373, 400, 436, and 470 billion. And so that's going to save 3.2 trillion. Again, the student loan provision, that's going to save 460 billion. 570 billion will be the savings from not doing the green subsidies under the so-called Inflation Reduction Act. There's also a little tax cut in here. As the IRS is going to get a little less money, and so they're probably not going to collect as much taxes. So, actually, the deficit will go up by about 120 billion there, according to CBO. But they're going to institute work requirements on food stamps and things like that. That's going to save 120 billion. So you have to be looking for work. That's the Republican plan. They don't want welfare; they want workfare. Let's see here, 29 billion rescissions of funds provided by 6 laws enacted from 2020 to 2022. I think that's COVID spending coming to an end. That's another 30 billion. Energy leasing and permitting provisions. That'll save another 3 billion. And then because of all these other savings, we're going to save about $4.3 trillion of actual spending cuts off of the baseline. We're going to save about $547 billion in interest. So when you cut spending, you reduce the amount of interest that we owe on the national debt. And that all adds up to $4.8 trillion of spending cuts that House Republicans have not merely proposed, they've already passed it. And the bill actually increases the debt ceiling. All of these cuts have nothing to do with Social Security and Medicare. Don't listen to the White House. Don't listen to congressional Democrats. They're not talking about Social Security and Medicare. We're talking about caps on discretionary spending, getting rid of green energy subsidies, ending Biden's student loan forgiveness program, and reducing interest owed on the national debt. So when you add all this together, 4.8 trillion, that's really without touching Social Security and Medicare. I look at these numbers every single year, and I am impressed with what the House Republicans have come up with, and I wholeheartedly endorse the Limit, Save, Grow Act. I think that it should be passed. I think the Senate's taking it up into consideration. Mitch McConnell's told Biden already, hey, you've got a choice. You can either pass what the House Republicans have just passed, or you're going to negotiate with House Republicans and come up with some other deal. But they're not going to go and pass some so-called clean debt ceiling over there in the Senate. So so far, and this is why you need to send your letters to Congress, especially the Senate, to pass the Limit, Save, Grow Act, is that this is where the rubber meets the road. Senate Republicans need to hold the line and keep at 41 senators who are saying we're not going to pass a no strings attached debt ceiling when the national debt's going up to $51 trillion by 2033, or maybe even more than that. And believe it or not, this is just the start of what must be done to begin to get our fiscal house in order. Slowing down spending will help the economy to catch up to our debt burden, reduce inflation, and put less stress on U.S. financial institutions to shoulder the massive debt burden going forward. In the meantime, President Biden is playing chicken with default, refusing to consider even modest cuts. He's saying that this debt ceiling is kind of non-negotiable, and that, they're willing to talk about the budget, though. He can tell his, friends on Capitol Hill, the Democrats, whatever he wants. He can tell the American people whatever he wants. It's the same thing. If you're negotiating reductions in discretionary spending, if you're going to do sequestration again, just like John Boehner and Barack Obama were able to negotiate on the debt ceiling in 2011, it's the same difference. So if they want to walk away and say, we didn't negotiate on the debt ceiling, we're just cutting deficits by 4.8 trillion in accordance with the Republican plan, everyone's going to walk away. And, Republicans, I think, are going to win this. I think they're in a very strong position here. Joe Biden's not going to want to default on the debt, because presidents get blamed for recessions. He's going to be running for re-election next year. He needs to get this deal done. And frankly, it'll probably help him get reelected if he does these spending cuts right now, because then inflation's going to come down. There'll be less stress on U.S. banks to keep on purchasing treasuries going forward. I think it's a win-win. The truth is, no bill raising revenue can become law without first originating in the U.S. House of Representatives under Article 1, Section 7 of the Constitution, making Limit, Save, Grow the only game in town. Biden is going to have to sit down with McCarthy sooner or later and start this very important conversation before it's too late. This is Robert Romano, Vice President of Public Policy with Americans for Limited Government, dailytorch.com. Hit that subscribe button, ring the bell for notifications, and have a good day.